Hey, so this is a new microphone. It has a mute button apparently, and no one told me that. Okay, so sorry for that. I'll say that again. Good morning, good afternoon, depending on where you're joining us from. I'm Clinton Johnson, the Managing Director here at Benchmark International's Tampa office. And today's webinar is going to be about the outreach process and the buyers and building the overall strategy for selling the business with a consideration towards different buyer types and how you should tweak that process towards different buyer types and what you should be thinking about during the process and how to interact with those buyer types to get them all the way through the funnel to a successful closing. As always, we'll start off with a little bit of housekeeping here, technology, besides the fact that we have a mute button on the microphone. If you look on the left-hand side of the screen, as always, there's a little orange arrow. You hit that orange arrow and you can do two things. One, you can send us your questions. We'll have time at the end to go through those questions. Wade is here with me here in the room, and he'll be compiling those questions and throw them out to me at the end. He may answer a few of them as we go through the webinar, but we'll have probably 5 minutes at the end for that. So feel free to send in questions at any time. The second thing is we have, as always, some documents that you can download, a couple of things about Benchmark, and then we have 2 editions of our magazine, The Mark. We produce one copy that's got a slant towards the US market and one copy that's got a slant towards the European and African markets. So you can download both or the one that is most relevant to you. And then a new document we have this time, I was asked to present to offer a way that people could follow us on our various social media outlets. So you see the Follow Benchmark social media PDF there as a one-pager. You can download that and figure out how to find us on Twitter and Facebook and LinkedIn, all the different our blog posts and our different social media outlets. So a lot of good content there. It's similar to the webinars, but in a shorter, more compact version in most cases. So I invite you, if you like the webinars, you're definitely going to like some of the content on the social media outlets that we have. Okay, so with that, let's get into it. How to appeal to the broadest range of buyers. So what we're talking about today is kind of, we're taking the world of mergers and acquisitions and we're overlaying it on what is essentially high school economics, the laws of supply and demand. So you remember you have your supply curve and your demand curve, and the way you get higher prices is you move that demand curve up and to the right. And so attracting buyers is the equivalent in the M&A world of moving the demand curve up and to the right. So if you go to market with a process that attracts the wrong type of buyers for your company, or it only attracts a very limited range of buyers, you're having the opposite effect. You're moving the demand curve down and to the left. So it's gonna result in less chance of having a sale and a lower price on the end of the sale. So if you kind of think about that as the philosophical background for what we're talking about, basic demand curve stuff applied to the M&A markets. So that was when we were sitting around deciding what to do for this month's webinar. That was what we decided, and that's what we want to communicate. How do you push that demand curve up and to the right when it comes to attracting the buyers, working the buyers down through the funnel and getting a deal closed with them? So that's what we'll spend the next 55 minutes or so talking about. So there'll be 4 parts in today's presentation. First, I need to kind of do a level set. So when I use some terms, I think in order to understand parts 2, 3, and 4, I want to make sure everyone understands the terminology that we're using. It's not, it's not necessarily textbook terminology or defined by statutes. It's just the common parlance of M&A in the lower middle markets and the middle markets. So we'll spend some time talking about that, and then we'll get into the meat of it. We'll talk about 5 questions you need to ask yourself about yourself when it comes to buyer types, and then we'll talk about some strategies of how you apply those questions to this, the answers to these 5 questions to the different types of buyers to keep that door open as far as possible, keep that demand curve up and to the right. And then lastly, we have the big secret. And so it's not just a marketing gimmick that I said you got to wait all the way to the end to get the big secret. It's really the sequencing. You won't understand the big secret, and you won't be able to utilize it very well unless I go through steps 1, 2, and 3 first. So there's going to be a big secret at the end about this issue, and that's how we'll wrap it up. So let's get to it. Let's start level setting our terminology here. So we talk about 3 different buyer types. The first buyer type is what we call a strategic buyer. And this is, there's some difference of opinion of how you divide buyers up. But for larger businesses, there are essentially 2 types of buyers. They are either strategic or they are financial buyers. Now, for smaller businesses, let's say businesses that have a sale price of $10 million or less, there's a third type of individual, a third type of buyer. Oh, I spoiled it. It's the individual buyer, sometimes called a high net worth individual, but that's really a bit of a misnomer. And so, if you're dealing with a larger kind of $100 million businesses and above, you just think of in terms of strategic and financials. There aren't many individuals that will show up and buy a business for $200 million. But again, if you're 10 million and below, you really need to be thinking about this third group of individuals because they really have distinct characteristics. There are different ways to reach them, different ways to handle them. They have different concerns. They have different priorities. So here at Benchmark, we look at buyers, broadly speaking, in 3 different classes, and that's fairly common across the industry. So how do you define these? So what is a strategic buyer? A strategic buyer is one that has operations that they either want to expand or improve upon through buying a company. Some examples of strategic buyers would be your competitors, or they would be your suppliers or your customers if maybe they're trying to do what's called vertical integration to control the supply chain or to get more direct access to the end user. They could be people in adjacent industries. So a hardware company will buy a software company. So for example, Oracle, which was a software company, bought Sun Microsystems, which was a hardware company. That's kind of old news now, but that was something that actually I worked on a while back. They could be buyers could be public or private strategic buyers. So publicly traded stocks being ones that are like on NASDAQ, New York Stock Exchange. Their stock actually has value and you can trade it freely. It's liquid type of investment. It's kind of between privately held stock and cash because it's fairly liquid. And then you have your private company buyers who have stock, and yes, the stock is worth something, but there's not really a market for it, so it's very illiquid. But these are kind of 2 subsets of strategic buyers, and approaching public buyers and approaching private buyers is a little bit different because they have different concerns, different priorities. A lot of people listening in may think that the business is too small to attract a public acquirer. But if you run a well-run process, there's almost no limit to how small a deal a public acquirer will do. We sold a business to the Chicago Board of Options. Was it last year or maybe 2 years ago now? Late 2017, 2018. So Chicago Board of Options is definitely publicly traded. I think their market cap is like $13 billion now, billion with a B. Our client had 7 employees. So if you can take a business that has 7 employees and sell it to the Chicago Board of Options, there's a whole lot of businesses that are very small that can attract the interest of a public strategic buyer. Now, how you get to them is a little bit different, and the 1 hour we have today, we're not going to dive too deep into the difference between attracting public and private strategic buyers. We're going to kind of stay in that top level and kind of lump all the strategics together, but that just be advised that there are kind of 2 subsets there. Okay, so that's a strategic buyer, what they're trying to do and what some examples of what they are. Let's look at what a financial buyer is and get some examples of that. So a financial buyer is a buyer with money to put to work. So strategic had operations they want to improve or expand. Financial has money that they want to put to work. So the 2 most common examples of financial buyers are private equity funds and family offices. Just to make sure everyone understands, just a quick background. So a private equity fund will typically have a general partner or management company that goes out to other individuals or other entities like pension funds, insurance companies, and ask them to be passive investors in their fund. And then that management company or general partner goes out, makes a series of investments, and they typically have a finite timeline to make the investments, grow the businesses, sell the businesses, and return the money to their limited partners, those pension funds and insurance companies. And that may be kind of a 10 or a 12-year lifespan that they have to do all of that. That's the quintessential standard model of a private equity fund. So again, they're very much driven by buying, building, selling. Whereas a strategic buyer, they're going to buy and probably not resell the business. Then you have the family office, which is another type of financial buyer. A family office is typically a wealthy family that has made a lot of money through one business or another. And as all wealthy families do, they invest in some publicly traded stocks, some real estate, some hedge fund stuff. but a lot of them will take a piece of their wealth and look towards buying private companies. And in a way, they're like a private equity fund, but they're not investing other people's money. They're only investing that one family's money. And they will typically hire professionals, a smaller team, but nonetheless a professional team to make those investments for them and manage those investments. But unlike a private equity fund, they don't have a finite lifespan when they have to get in and out of a business. So they can have longer holding periods, or sometimes they buy and hold, much like a strategic buyer will do. So family office may be kind of, in between, a little bit in between a more traditional private equity fund financial buyer and a strategic buyer. But technically they're a financial buyer because they're looking to invest money and get a return on the money. So as you can imagine, the type of the reasons why strategic buy versus the reasons that financials buy are different. The things that financials worry about and strategics worry about are different. The things that excite strategics and excite financials buyers are different. The way they analyze a business is different. The way that they analyze financial statements is different. The way that they deal with operational data is different. Their plans for what they're going to do with the business after they buy it are different. So you can hopefully already see why it's almost kind of two entirely different marketing strategies that you would ideally have to go to financials and strategics. And the market doesn't allow you to do that. You have to have one marketing strategy that captures both of them. Now, when we go through these questions in step 2, you may realize that you're probably more of a target for a financial than strategic, or vice versa. So as you build out your marketing plan and you undertake your marketing efforts, you're going to aim them where you're going to get the highest return. And that's what we're going through today. So strategic, financial, I'll get to individuals in a moment, but there's one other type of buyer that doesn't fit on this grid, and that is what we call a hybrid buyer. So when a financial buyer, such as a private equity fund, goes out and buys its first company in the industry, that's called a platform investment. And they bought this platform investment, and as I said, a private equity fund has to grow it and resell it in a fixed amount of time. So they'll work on organic growth, enhancements, improvements, efficiencies, but in order to get the kind of returns that they need for those, limited partner, the insurance companies and the pension funds, they got to juice that growth somehow. And the way they typically do that is they take the platform business and the private equity fund together, and they go out and they look for what's called add-on acquisitions, called add-on, bolt-on, tuck-in acquisitions. But they're generally smaller companies that they can merge into or make subsidiaries of their platform investment. So what you have going out to market is the private equity fund, a financial buyer, in conjunction with the platform business, which is a strategic buyer. So they're both financial and strategic, and that's why we refer to them as a hybrid buyer. And this is for lower middle markets, this is incredibly popular. Most private equity funds are looking at platform businesses that are bigger than a lot of small businesses that are on the market. So to become the platform for those larger funds, you have to have some weight. And so for every platform investment they do, they may then do 5, 6, 10. We know someone that did 19 add-ons recently. We sold them one of the add-ons, and now they put those 20 together, and now they're selling that off as one big unit. So there's a lot more add-on deals than there are platform deals, and add-on deals are more suitable for smaller businesses. So the first company that gets sold to private equity is being sold to a financial buyer, but the 2nd through the 19th are being sold to really a hybrid. And so all the things that we talk about today about financials and about structurals, strategics, are both kind of meshed up in there for add-on acquisitions. And we typically see in the United States, so in the United States, before I get to that, in the United States, financial buyers are much more significant than they are in the rest of the world. Middle market, lower middle market M&A outside the United States is still essentially dominated by strategic buyers. But the United States has a very mature middle market, lower middle market financial buyer pool. Now that's changing. All things, spread out and kind of globalized. and it's changing rapidly in some parts of the world. But we see the highest percentage of financial buyers in the United States out of all of our global operations. In the United States, what we see for companies, say under $100 million, we see almost year in and year out, 1/3 strategics, 1/3 financials, and 1/3 hybrids. So you could say it's 2/3 strategics and 2/3 financial if you wanted to. It would be the same analysis. And that leaves a little bit left over for the third class, the individual. So again, the individuals really focus on deals that are going to kind of be $10 million and less. And when we say an individual buyer, what we mean is someone that has money and they may be looking for a job. They may enjoy running a business. They may think that the only job that suits them is to be the boss and run a business. Or they may be kind of a small version of a family office and have some money to put to work. Most often we see someone that wants to come in and run a business. They're looking for somewhere to put their professional skills to work, as well as some of the money they've made over their life. So most commonly, these individual investors are either people who owned a business in the past and sold it, or they tend to be executives from larger companies that made some nice bonuses over the years and cashed out. So they've got a nice war chest to sit on to go and make that investment. And maybe they never were the CEO of the business and never actually ran a business, and that's really what they want to do. And they have the money and the time and the experience to go out and do that now. So we do a small percentage of our deals to individual buyers, and they are the smaller end of the spectrum. So if you're listening in today or watching today and you're on the smaller end of the spectrum, be thinking about the individuals in the back of your head. Some individuals are kind of like financials. Most of them are like strategics, but they're really not the same as either one. Kind of an odd mix there that gets thrown at the end. All right, so those are the three buyer types. We move on to the three objectives for your search. So our clients come to us with typically one objective in mind, and that is value. They want to get the highest value for the business, and that's what they talk about. That's what they talk to us about. That's what they're thinking about, and of course that's important. And for most of our clients, that remains the most important priority throughout the process. But as the process goes on, our clients tend to realize there are two competing priorities. And unfortunately, like all things in life, when you have competing objectives or priorities, there are some trade-offs. And so what we're going to talk about a little bit later on in this is, you've got to balance these three objectives and think about the trade-offs. So what are the other two objectives? So fit is the second objective. Is the buyer the right fit for me or my business? And the third objective is certainty of close. If I start a transaction with this buyer, what's the certainty that we're going to get to closing, or the probability that we're going to get a deal closed? So I'll elaborate on all three of those a bit. So when it comes to price or value, that's pretty self-explanatory, so I won't talk about it much, but it's important to always realize value has two major components in today's market and M&A. So 10 years ago, when in the good old days of 3x multiples, there was really, value meant price, because it was cash at close with, you get 90% of your money now, maybe 10% in escrow a year or two later. And that was how your deal was set up. But as multiples got higher and higher, and the relationship to the value people paid versus the cash flow that they had available to buy them got a little bit out of whack, the buyers have tried to outdo each other by adding structure onto the deal. So structure can either be deferred compensation or it can be contingent compensation. We'll talk about that in detail a little bit later. But when you talk about value, you're always talking about price and structure. Price and structure. There's two pieces that you always have to be thinking about in today's market. If the wheels come off and the markets go back to historical norms, then we forget about structure, and value equals price, and it's a simple equation. But that's not where we are today. All right. So again, that's kind of self-explanatory. Fit might be something that you're not thinking about. So there's two aspects to fit also, and one is, some clients, when they sell their business, they're concerned about family members that are employed by the business and are going to be sticking around, or they're just concerned about the employees regardless of whether or not they're family. Some clients are concerned about their customers. Some are concerned about their legacy. So in all company sales, there's an aspect of fit. We very rarely have a client who says, I don't care who the buyer is. I'd sell to the devil if it was the highest price. That's, they might say that when they come in, but they get into the process and this idea of fit grows in their mind, as it should. It's an important thing. So part of what we're doing today is putting this on the table ahead of time so everyone starts thinking about it. So as I said, there's kind of this concern about legacy employees, family members for all transactions. And then as we'll talk about later, it's very rare that the owner themselves is leaving or disentangling themselves from the business completely as a result of the sale. There's always going to be some post-closing level of involvement from the owner. So whether it's an employment agreement or a short-term consulting agreement, or if you're going to roll over, retain some ownership and become a partner with the investor or the buyer, the clients are always somehow stuck in the business a little bit after it's closed for an amount of time that suits their priorities. And so there have been clients that I love the letter of intent these guys submitted. It's great value. I would never work with these people though, so I don't want to accept their offer. And that happens. That's placing fit above value in some cases. And that's where we're talking about competing priorities. So fit, another key priority. The third one, certainty of close. So it is unfortunately a reality that deals that go under letter of intent do not close. We'll have a slide later where we give a lot of the reasons. But sometimes you run a process, you pick a buyer, you get almost to the finish line and the deal falls apart and you have to go back to market. Is that something that you can deal with? Is that something that your business can deal with? Is that something that the macroeconomic environment, right? If we're on the verge of falling off of a financial global economy cliff, then certainty of close becomes more important. If you have a business where you've had a couple really great years and you're not sure next year is going to be that good, certainty of close becomes more important. If you have a medical reason that you're selling the business, maybe certainty of close is higher. But these three priorities you need to be thinking about and balancing against each other as you decide what type of buyer you want to go after, and then as you decide how to work the different buyer types through the funnel. All right, last thing we're talking about here before we get into the meat of this are two different acquisition types. And I've already kind of jumped ahead on this. There's either a platform acquisition or an add-on acquisition. So platform buyers entering a new field. And some of the things I didn't mention earlier is that usually a platform acquisition is going to need to be able to run itself after it's acquired. So it's going to have a good management team in place. The owner may need to stick around longer than they would for an add-on acquisition. There's not going to be any synergies because the platform's not being put into another business. It's going to stand there on its own. And so basically when buyers are looking for platform acquisitions, they want what I call the well-oiled machine. They want something that's hit on all cylinders. They want business that's processed out, has some formality, has some structure, has the pieces in place to grow on its own, as opposed to an add-on acquisition where there's different reasons for an add-on. Maybe the buyer wants to expand the business into a new geography. Maybe they want to instead of offering, maybe they're a steering wheel manufacturer and they want to buy a windshield wiper manufacturer. So they're kind of expanding their range of offerings, or maybe it's a vertical integration. So the windshield wiper manufacturer is buying a rubber plantation, to take an extreme absurd example. But regardless, there's already a business operation, there's already a accounting system in place, there's already a CFO, there's already a CEO, and so there's going to be some requirements for the business being bought as an add-on. It doesn't have to be hitting on all cylinders. It doesn't have to have a great new CEO to take over when the buyer leaves. If it's running kind of an accounting package that's a little bit too small for the business, that's okay, because the buyer's going to want to migrate it onto the platform business's accounting system anyway. So add-on businesses like to say, they can be squeaky, they can have a little wear or tear on them. And that's going to be okay for buyers looking for add-ons. Okay, so now into the good stuff. Now we've kind of laid out all these terms that I'm going to use over and over again. And what we're going to do here is there's 5 questions here. So normally these webinars, I probably don't ask a lot of questions. I probably just try to give a lot of information. But here what I'm going to do now for the next 15 minutes or so on these 5 questions is lay out the questions and then kind of give you some market realities about how to think about these questions. And these are questions that you want to ask yourself before you start the process, and then you want to continue to revisit as you go through the process, because these will have a heavy, heavy impact on the type of buyers you should be trying to attract. All right, question number 1 concerns your involvement post-sale. Will you stay on for a short time to transition? Are you looking for an indefinite continuation with the business, or is there something in between? Because all of those things are possible. What's usually not possible is I'm going to sell the business and get on a boat the next day and sail around the world. Just 6 months kind of minimum. Anything less than that is a real outlier and can cause some problems. But fortunately, in today's world, with the broad range of buyer types we have, there is a buyer type out there, and there's a buyer out there that will be able to meet your expectation about your post-closing involvement in the business. So let me give you some of the market realities to help you analyze this for yourself. Okay, so I said earlier, platform investments need leadership. Add-ons, not so much. So if you think your business is a platform and you're going to be going out to market for buyers looking for platforms, then you probably need to, hopefully you're going to want to be open to sticking around a little bit longer. If you want to get out sooner, you probably need to go to buyers that are looking for add-ons. Again, this is not to the exclusion of other buyers, but how are you going to write your marketing materials? What are you going to focus your time and effort on? You're probably going to want to focus on people looking for add-ons. Okay. Another thing, financial buyers more often want the seller to stay on. So financial buyers are think Ivy League guys that love driving spreadsheets around on their desktop. They're very good with numbers, financial engineering, but they don't know how to make widgets. They don't know how to sell medical devices to hospitals. They don't know how to efficiently set up a distribution network. Stereotyping here a bit, but that's where they're coming from. They're numbers people. They don't want to go in and run a business. They don't want to go in and figure out how to, rearrange the assembly line so that the manufacturing gets done more quickly. That's something a strategic buyer would want to do, but not financial. So financial buyers rely a lot more heavily on the existing leadership. And whether that existing leadership is the owner staying on, or the owner is going to leave relatively soon, but they've got a good, strong second level of management in place, that's going to appeal to financial buyers. So again, why does it matter what kind of buyer we're going to? So you think about how you would put together your confidential information memorandum or your book. And how are you're going to have to talk about the management of the company in that book. You're going to have to lay out your preferences for staying on or not staying on, or how long you would stay on. And so you want to write it in there in the way that it's going to appeal to the most likely type of buyer. And of course, you want it to be as broad as possible and attract as many as possible, but there's always kind of a critical mass that you got to keep on line for driving down that. So there's just one example of why this stuff matters. Strategic buyers, bit of a mixed bag. Some of them, if they're a foreign buyer, they probably might want you to stay on as a head of their U.S. operations or their South African operations if you're in South Africa. But more often than not, they don't want to pay a lot for a CEO to stay on at the rates that sellers generally want to stay on as being a CEO. They have existing leadership, so they're going to want to fold it in there. So you can get a quicker departure if it's a strategic buyer. And then individuals almost always are going to want a short term. They pretty much want to come in and be a boss and run a business. And we've all probably had maybe not if you're a business owner, but most people have had a job where you got the job and the person that used to have the job is still hanging around the office. It's so annoying. It's not what people want. It's not what individual buyers usually want. So if you think about it as a spectrum, financial buyers probably going to stick around for a long time and be very important. Or if not, your next level of management that's going to step up and take over is very important. Strategic buyers kind of in the middle. They can go one way or the other. Individual buyers, quick exit, get out quickly, get out of my way. Don't want you second guessing everything I do type of situation. So the key takeaways for this question, be honest about this with yourself. Don't go in with the preconceived notion that I need to do it this way because you may tell yourself that and set up your marketing efforts that way. And then when push comes to shove and the time comes, you really realize, you know, I thought I had to do it that way, but I can't stand that. That's not really what I want. And that's not good for anybody involved in the process. So try to figure this out as soon as possible, and really be honest with yourself. Second of all, I said it once already, and I'll say it a few times today, be open to change. It's not that we encourage our clients to change their mind, but we just see it happen so often as you go through the process. You know, our typical client says, I hate the business, I want out, I sell this thing as soon as possible. And then they go through the book building process, and they go through the marketing process, and they meet with buyers, and they hear the buyers tell them the great things about the business, and they start to see their business in a new light, and they realize, I don't hate the business. What I hate is making payroll, dealing with the landlord, you know, these type of things. If I could just get back to being the head of sales again, that's what I want to do. Or if I could just get someone to come in and who would come in and put a proper back office in place for me and free up my time so I could do executive level things, that's what I want. And so that we tend to see people moving from, I want out 100%, I want a minimum involvement, to I do like my business, and I got a lot of good years left ahead of me, and I want to stick around. So continually reevaluate this question as you go through the process. That's the second takeaway. And the third one is, the more flexible you are, the wider range of buyers you can attract. So if you force the broker to put in the book that you're going to stay for a 6-month transition and leave, you're going to lose a lot of buyers, particularly the financial buyer type right off the bat. Particularly if you're, you know, financial buyer looking for a platform business. You know, unless you say, I'm going to leave right away, and that's okay because I spent the last 3 years building a new team, and here they are, and they're great, and I've got a bio for each one of them in the book. And trust me, every time you talk with me, I'm going to tell you how great my second level of management is, right? So again, there's reasons why you need to be honest so that the process can be tailored to reach as many buyers as possible, but certainly the right type of buyer for you. Second of the 5 questions, your ownership post-sale. So as I said, a lot of people want to sell and get out right away, but with multiples as high as they are, we're seeing that happen less and less. So you need to ask yourself, do I want to retain any ownership, or do I want completely out? And if I'm going to retain ownership, how much ownership would I want to retain? So the realities here are, there are kind of 3 different sets of buyers. The biggest distinction is there are buyers that will only make a minority investment. They will only buy less than 50% of the business. They will not cross over. And there are other buyers who will only buy controlling interest or a majority interest, 50% or more, and they will not cross over into the minority realm. And you've got to market the businesses very differently. You've got to go to different places to find those buyers. So that's something you don't want to change your mind on halfway through the process, because you have to start over at that point. The next distinction to make there is within that majority field, which is where this presentation is really aimed. That's what Benchmark International really focuses on. In that majority realm, do you want to sell 100%, or do you want to, or are you willing to hold on to 20, 30, 10, some percentage of the business? And that's where you can change your mind after the deal starts. And in fact, most of our clients change their mind depending on the particular buyer. Hey, with this buyer, I want to roll over or retain as much as possible, because I know, for example, if they're a private equity fund and they have to resell this business in, say, 5 to 7 years, I was planning on sticking around for 5 to 7 years anyway. So they're telling me that they have a history of buying companies and selling them for 4 times as much. So if I say, if they value my business at 100 and I sell 80% now, I'll take 80 now, I'll keep 20. And then 5 years from now, I'll sell that 20 for another 80. I'll get 160 instead of 100. So I want to roll over with these guys. I want to be in business with them. I want to be partners with them. So that kind of distinction of how much will you keep once you've decided you'll keep a minority interest yourself can be made on a case-by-case basis, but you don't want to go into it cold and when the offer first comes up, be taken by surprise. You should be thinking about that throughout the process. A couple issues with that. As we know, the higher the risk in something, the lower someone will pay for, right? If there's 2 used cars for sale, one has the service records and one doesn't, and they're otherwise identical, you will pay more for the one that has the service records because there's less risk. So we're always looking at ways when we build a company sale process to suck risk out of the system for buyers, and each type of buyer looks at risk differently. But all buyers pretty much see 100% sale as a sign of risk. Why are you selling? Are you afraid this thing's about to spin out of control? Are your best years behind you? Has your number one salesperson given you notice that they're leaving? Right? There's always some suspicion, and there should be, and it's natural. And but showing that you want to reinvest in the business is a sign that there's nothing to be worried about. So buyers take that as a big relief, and particularly again with the high multiples we're seeing now. High multiples are risky investments for buyers. So anything that can take a risk helps get those higher multiples and attract more buyers. So putting in the materials ahead of time that the buyer is open to rolling over a minority interest will attract a lot more buyers. It will particularly attract financial buyers. It'll have a little bit of effect on some strategics, but Chicago Board of Options I mentioned earlier, they're not going to buy a company and let someone hold on to 10, 20% of it. That's not what they told me, but I just know in general that's not the way it works. So, strategics a little less interested in this issue. Financial buyers definitely see a lot of value in having an owner, even if they don't take the owner up on the offer to roll over. The fact that the owner made the offer in the information memorandum is a big sign of confidence and helps attract attention and drive up value. So that's the plus side of taking a post-ownership stake in the business, retaining some of the business. The downside is, or one of the downsides, is that selling less than 100% is a much more complex transaction. If you're selling 100% of the business, it's a one-time transaction. But if you're going to stay on as a minority owner, you're going to need protections. There's going to have to be changes to the articles, the bylaws. There's going to have to be minority protection rights. There's going to have to be shareholders or operating agreement. So you get a whole other suite of documents that has to be drafted, a whole other set of things that have to be negotiated. It gets a bit more complex. Let's see. Oh, so second of all, so I mentioned, let's end it on a positive little Oreo here. I had a good thing, a bad thing, and now a good thing, which is cash at close. So oftentimes the maximum value a buyer will pay is not limited by what they value the business at, but it's how much cash they can actually put up to buy the business. That's why we have the structuring issue that I talked about earlier. Well, rollover is one form of structuring, right? So if they value the business at 100 and they really think it's worth 100 and they want to pay 100, but they can only get together 80 to buy the business, if you'll roll over 20, you've just solved the problem. So reducing the cash at close will bring more buyers in, keep more buyers interested, and hopefully lead to higher value as well. So the key takeaways, I'm not going to say the first three again because I said them on the first slide. And we will, by the way, after the presentation is done, email you copies of these slides. This is a very text-rich presentation. Usually I try to keep the words to a minimum, but as we developed this one, it just wound out that we needed a lot of text. So the first three I'm not going to repeat. The fourth one, though, is that this question, probably more than any other, affects how you balance the three priorities: value, fit, and certainty of close. So this is a really, really important one that you want to talk to your attorney, talk to your wealth manager, talk to your accountant, talk to your broker early and often about this, okay? All right, number three, risk tolerance. So as I mentioned earlier, structure. So if you have a very low risk tolerance, if you're risk averse, you're going to not like deferred and contingent consideration. Most business owners are pretty risk tolerant, not risk averse. It takes a lot of ability to deal with risk to go out and start your own business and grow your own business, and it takes some risk control to go out and sell your business. So generally buyers come in, willing to entertain the different types of structure. But every buyer has to ask this question, has to ask this question of themselves and come to an answer. So some of the things to help you figure out where you sit on this question. I said it before, today's high multiples are only possible because of structured deals. If you want 100% cash at close, turn the time machine back 10 years, go out and get your 3 times multiple and sell it for cash at close, or wait 5 years, 2 years, 8 years, whatever, until the markets return to normal, get your 3 times multiple, take 100% cash at close. So in order to get today's high multiples, structure is a reality. In addition, if sellers come across too interested in cash at close, it's much like saying I want to sell 100% of the business. I want no structure. I want all cash at close, and I want to leave the day after closing. That scares, those three things put together scare off buyers tremendously. A willingness to accept structure shows that you have confidence that the business will be grown and be successful in the future, lowers risk, attracts buyers, improves multiples. Then, structuring is a win-win scenario. Suppose that, the only option is 100% cash at close, and that the offer achieves 80% of the seller's objectives and 80% of the buyer's objectives. So it's a fair deal, and the deal gets struck. But if you introduce structuring, you may be a way to achieve 85% of the seller's goals and 83% of the buyer's goals. So it's a win-win scenario. And so why is that possible? It's possible for a number of reasons. Tax structuring is one issue. So buyers, being entities, are taxed one way, and sellers, being typically individuals, are taxed a different way. It could be that the buyer is taxed as a C corporation and the seller is taxed as a S corporation. So there's a lot of tax differences in there that can result in that. Also, different cash flow needs. What are you going to do with all that money on the closing date anyway? It would not be wise to take out all that money and go and spend it right away. So do you really need it all on the first day, or could you take some of it a year or 2 years later? It's probably not that important to the seller what they actually need the money to use it. Whereas the buyer, because we've squeezed every penny out of them on the purchase price, and because they're going to want to put money into the business to grow it after they buy it, cash flow is very, very precious to buyers. So that's a second reason. And then risk appetites. One party may be risk averse, one may be risk tolerant. There may be some arbitrage on the risk views there, but it can be a win-win scenario. It's not just about the buyer getting something and the seller losing something if it's handled well. So the last point on this is that 10 years ago, as I said, there wasn't a lot of structure in deals. So you may have heard some stories of someone who sold a business 8 years ago, 5 years ago, and there was structure and it was horrible. Well, what happened is bulge bracket deals, publicly traded companies had this structuring, they had these sophisticated transactions, and over time those started floating down. So when they got to the lower middle markets, the brokers and the attorneys didn't know how to handle them very well, and they didn't put the protections in there that the sellers needed. And the market norms, there's a different way to do it when you're a bulge bracket or publicly traded business than there is when you're a little middle market business. And those models of structure hadn't been adapted to the lower middle markets and middle markets. They have now. Norms have evolved. Advisors have gotten intelligent about what those norms are, how to protect their clients, how to explain to their seller clients what the risks are, and some new creative structures have been developed. So easy example here, in the publicly traded markets, you can have an earnout that's based on income. And because it's publicly traded, nobody's going to cheat on the income. They're not going to artificially lower the income because it'll cause the stock price to fall, and they might have securities violations. But in a lower middle market, nobody really, a buyer very rarely cares what the actual net income of a business is for the year or two after they buy it. So there's a temptation for them to kind of maybe incur a bunch of expenses right at the end of the year and drive the net income or the EBITDA down. So when these earnouts came to the lower middle markets, it took a while, but everyone understands now an EBITDA or net income based earnout is not right for the lower middle markets. It needs to be based on gross profit or revenue or some other metric that's not as manipulatable. And so fortunately now, these things are in place and structure is a lot more safe and convenient than it was if you've heard some war story from, however many years ago. All right, key takeaways. Be honest, right? You don't want to go out and attract the wrong type of buyer because you're trying to, you have bravado and you say you can tolerate any risk, or some person on the golf course told you never take structure, and that's just one person's view. Make sure you're honest about it. You're collecting information. You're making an informed decision. Always be open to change. The more flexible, the more buyers. Same points, okay? And again, the balance. It's going to affect your balance of the three priorities. Number 4. All right, view towards a do-over. So what happens if I go into the process falls apart 6 months in or 3 months in? 6 months is probably an exaggeration, but 3 months into the process, what consequence will it have? How will that affect me? How will it affect the business, right? So some of the realities here. It is true that many LOIs, letters of intent, do not result in closings. There's a lot of legitimate reasons why that happens, and there's a few not legitimate or less than legitimate reasons it happens. I'm not going to read them. They're on the screen there. But there's nothing you can do to ensure that every LOI that signs results in a closing. So this is why certainty of close or probability of close is always an issue. Second point here, higher reward is higher risk, right? Somebody comes in with an offer that's 20% higher than the other offer that comes in at the same time, but the 20% higher, so the lower offer is someone who has all the money in the bank account. They show you a bank statement that shows they have the equity portion. They show you commitment letters from banks for the debt portion, and you're all set. And the 20% higher price comes in, and they've never done a deal before, and they say they can get the money, and they say they have friends that are bankers. Which one do you want? You can take the 20, you can take that risk and try to get that 20% extra, but you understand that may fall apart. You may be back on market in 3 months or 2 months or a month, and you may be going back out to market. Do you want to take that chance or not? That's your decision to make, no one else's decision to make. So you have to decide if you want to take that chance. Last point here. So running a do-over actually often results in a higher price in recent years. Most companies are growing, so if you wait a little bit longer, you get a little more money. You're always growing until you're not growing, and then you have a mess on your hands. So 9 out of 10 grow a little bit and get more, but 1 out of 10 loses a little bit and gets a lot less. So it's a risky game to play, but generally, on average, companies have been growing as long as the economy holds steady. You do learn important lessons the first time around, so the second time is a little faster, a little more streamlined. Maybe there's a couple little pitfalls that you avoid as you go through it the second time, particularly for the owners' meetings with buyers. They've probably learned a lot about how to act in those meetings, and they're more comfortable the second time through, more confident, more to the point. They have a little better idea of what kind of buyer they want, so they're a little more selective in the process. So the second process is usually a lot better than the first one for a lot of reasons. And there is this concept out there of a blown deal discount. Well, your deal fell apart and the deal was at 100, so now I'm only going to offer you 90. But that can be eliminated. You have a good broker that gets in front of the process, and so because the buyers will always find out before the deal closes that there was a prior offer on the table that was accepted and didn't close. They will always find out. It can't be hidden from them. So the broker gets out there, we get in front of that, and we explain what happened. They couldn't get the bank lending on the deal because they had a debt to equity ratio 70 to 30, whereas yours is 40 to 60, so you shouldn't have a problem. Or we didn't have an inventory control system in place. We went out and got one. We were off market for 3 months. Now we solved that problem. Now you'll be able to get lending. So as long as you explain what happened and explain why it doesn't apply to buyers now or wouldn't apply to any buyer now, you can avoid that discount. So having a do-over is not the end of the world. Key takeaways: think ahead. How you're going to price. This is a big one. Value and fit are kind of on one side, and certainty of close is often a trade-off. So many of our clients get an offer that looks too good to be true, and they, we tell them, listen, there's a reason they're overpaying because they probably don't know exactly what they're doing, or they're going to have trouble getting the financing for this. Do you want to try it? Yeah, let's try it, and it's worth a try, and we try it. But usually it's an obvious trade-off. And blown deal is not the end of the world. It'll add time to exit, but you can do it again. All right, last question, foreign buyers. So here again is 2 different types of buyers. Do you want foreign buyers in your process? Some realities, some foreign buyers will often pay the highest value, particularly for smaller businesses. If they're coming across an ocean or across from the other side of a continent, there's a reason that they're doing that. They have some kind of pressing need. So people with the biggest needs pay the highest multiples. So we always like to try to get foreign buyers into the process because that's where you'll get your outliers, your quality outliers, right? You can have your high risk certainty of close type of buyers that offer really high prices, but oftentimes foreign buyers are solid buyers that are willing to pay the highest price. So they're good to have in. So they will often pay the highest price. They also have a lower certainty of close than a comparable business that's domestic. It may be because it's their first deal. It may be a linguistics barriers, it may be cultural differences. It may be that you can't get to a good fit with them. It may be that they can't get the money out of the country. there are a lot of extra risks associated with a foreign buyer, even if they are a quality buyer. So it's a bit of a trade-off, price, value versus certainty of close there. You can get deals as small as $2 million done with buyers from the other side of the world. That wasn't true 10 years ago. It was very rare 10 years ago, but global buyers are doing smaller deals nowadays. So just don't think your business is too small to attract a foreign buyer. But the smaller you are, the bigger the opportunity it takes to find those buyers. So if you're a smaller business that really wants foreign buyers, you got to have a really robust outreach program with someone that knows how to get to those buyers. Foreign buyers are more likely to want you to stay on. They're more likely to want you to roll over equity because they're seeing more risk. Everything's farther away and other cultures are always more risky. So anything you can do to mitigate risk has more of an impact on a foreign buyer than it does on a domestic buyer. All right. Oh, sorry, I was going backwards. Okay, keeping the door wide open. I'm going to go through this quickly here. Develop the right strategy. You want to keep those 3 priorities in mind and how you're going to trade those off against each other. You want to have one sale effort. You do not want to have multiple sale efforts going on. As I said, you can't kind of go to market with one set of things for financial buyers and one for strategic buyers. That will backfire. So you need to have one strategy that's focused on attracting as many buyers as possible, but is also kind of driving down the middle of the road with the most applicable type of buyer based on your priorities. The right outreach. So again, getting as many different buyer types as possible in and having your story told correctly to the different buyer types involves, for example, multi-channel outreach. Some buyers, for example, for financial buyers, private equity funds, they look at hundreds of opportunities a day and they want a one-pager to look at, and there's certain things they want on that one-pager. A strategic buyer may not even be of a mind to go out and do an acquisition until you show up and say, you know, I've noticed you don't have many sales in the state of Nevada. I have the #1 seller of this thing in Nevada, so you should buy my client. Hey, that's a good idea. We should make an acquisition. Very different approach. And how you reach those people, some respond to email, some respond to phone, some you have to see face to face. Some will only answer through a known contact. That's the only way you can get their attention. Very true of large strategic buyers. You can't just fire off a single page teaser to a lot of them and get their attention. You got to get to them through a back channel oftentimes. Private equity funds, on the other hand, as I said, they just want a one-pager and they want to move on. Yeah. You also need follow-up. So you can't make one outreach attempt to a buyer and then let it go, because you're basically making an unsolicited sales call on them. What's the likelihood that if they were on vacation, they're going to answer that once they get back a week later and their email stack is this deep, or their pile of mail is this high, or whatever, they have 80 voicemails. You have to follow up and you have to follow up different ways and different amounts with different buyer types. Finally, broad. It's hopefully starting to sink in now. If I talk about these trade-offs amongst different buyers and trade-offs amongst your different priorities, broad outreach is very important because your mind's going to change over time. So you don't want to have only gone to a narrow segment that no longer suits your revised objectives. And different things are going to appeal to different type of buyers. And there may be something that you don't even understand about your business that will appeal to one type of buyer, but you thought it was going to be a different type. So you want to always err on the side of being broader as opposed to narrower. Sequencing information. So you could take a book and you could write a 180-page book that tells everyone about the company. It tells people everything they need to know about the company and send that out, and you would not get a very good response. You have to sequence things, and you have to have a bespoke process that when a buyer calls in, you say, okay, this is a strategic buyer, so I'm going to answer the question this way, or it's a financial buyer, so I'm going to drive the conversation that way, or this is an individual, I know they're going to be concerned about this thing, so I need to address it in the following way. So you have to have an intelligent, responsive process, and the only way to do that is to, as I said, run it through a funnel. It has to be, the information has to be sequenced, and private equity guys just speak a different language than, say, a strategic buyer that's never done an acquisition before. And if you just give them all one book that has all the details, you're going to lose a lot of potential buyers. So sequencing is very important. The way they look at it, the stuff they look at, the stuff they get excited about, and the stuff they worry about is all different for different buyer types. The same is true for your financial presentation, right? So financial buyers are more interested, they'll first look at financials, try to understand the business that way, then pick up the operations. Strategic buyers tend to look at operations first and then verify it with the financials. They're more comfortable. A strategic buyer can generally walk into the business, kind of look around, talk to people, get comfortable. Financial buyers got to pour through monthly spreadsheets and analyze them until there's nothing left to analyze before they can get comfortable. So you got to have, you got to figure out which buyer you're going to, figure out how you're going to emphasize operational data or financial data in your marketing. Either way, you're going to have both, and you want both to keep that outreach broad. Talking to the buyers, right? So after they get the confidential information memorandum, the CIM, then comes the first meeting. So when you go into that first meeting, think about your buyer type. So think about all the things we talked about different priorities that different buyers have and different concerns that they have. Think about that when you're preparing to speak to them and how you're going to answer their questions and what subjects you want to bring up in the meeting. And then when you prepare for the meeting, think about your strategy, think about the buyer type, think about how you're going to balance those three objectives. Remember that when you're selling a business, it's not all the buyer asking you questions. You need to know how well they're going to satisfy those three objectives. So in these meetings, you want to have thought out your concerns and priorities on these, and you're going to want to ask questions about them. Not only do you want that because that's what you need to get a deal done, but buyers actually appreciate that. It shows that you're serious. It shows that you've thought about the process. It shows that you know what you're doing. You're going to be a little harder to kind of push around or trick. You're all in on this process, and that's going to help get your deal done. All right, the big secret right here. I run a little short on time. Here it is. This is something that people don't think. When we help clients build books, they don't realize this. Buyers want companies with defects. If you have the perfect business, it can be hard to grow the perfect business. So defects are good. Oftentimes clients say, don't mention any shortfalls about the business anywhere. Don't bring those up. Let's just hope that they don't discover them and they buy the business and find them the day after closing. Never going to work. And it's counterproductive, right? They want things they can come in and improve. So the issue here, why we're talking about this today, is that different buyers want different types of things that they can fix. They don't want to see problems they can't fix. So let's look at the different types of problems the three different buyer types like to find. Financial buyers, okay, your private equity funds, your family offices. They like ways to improve cash flow, lower interest rates, put financial controls in place, improve the accounting system, things that they can throw money at to fix. So your cost of capital is too high because you're borrowing too much money. So if we put a little more equity in, we can get rid of that high cost loans and interest and get the cost of capital down a bit on the debt side. That's the kind of stuff they like to fix. So if your business has those kind of problems, those are the things that in the process get revealed earlier to that type of buyer and later to a strategic type of buyer. What do strategic buyers look for? Strategic buyers want to come in, they want to make operations more efficient, right? They want to reroute the truck patterns. They want to take advantage of economies of scale. We have 100 trucks, you have 100 trucks, you put the business together, we only need 150 trucks so we can cover the same, we can generate the same revenue. They want to look at rationalizing processing. Your margins are too thin because your cost of your supplies are too high. Well, we buy 10 times the amount of supplies you buy, so we get the supplies at half the price. So as soon as we buy you, move your supply contract over to our contract, we just improve the margin on the business. That has value to us as a buyer, right? That's something that a financial buyer can't do. A financial buyer might look at it and say, your margins are thin because your interest rates are too high. We can get lower interest rates. Hey, I just improved the margins. I made the business more valuable. I'm winning. So again, examples of two different types of problems. What do individual buyers look for? So individual buyers like smaller problems. Understandable, right? You probably would have thought of that if I gave you a second to think before I ran right into it, but they like things that they as an individual can tackle. They don't necessarily want to throw more money at it. Individual buyers tend to go out and buy the biggest company they can buy with all the money they have available. If they want more money, they're going to have to borrow money, and they probably borrowed money to get the purchase price that you're going to force them to pay. So they probably don't have a lot of extra money. So they're like little problems that they somehow think they're smarter than you and they can fix them, and that's great that they're smarter than you, and good luck fixing those problems. It's kind of where you want to go with the individual buyers if you're a smaller company. Last piece, the takeaway here on this slide, If your company has nothing that the buyer can improve, there's probably not a buyer out there for the company. Buyers buy because they can improve, because the business in their hands is worth more than the business in your hands. And if your business is perfect, that's not going to happen. Fortunately, there's no such thing as a perfect business. So every business is sellable if you know how to get the right buyer type, and if you know how to work them through that funnel and get that deal done. And if you're honest to your 3 priorities and how you're going to balance fit, value, and certainty of close against each other. So just about ran over. Short time for questions, but we'll stay on. I did run over. Sorry about that. Do we have questions? You will all be receiving a survey, by the way. Please do fill that out. We do make improvements as a result. For example, this fancy microphone with the mute button. Someone said we didn't have good audio, so on a survey, several people did. So we thought we improved it, but we need the mute button. So don't tell me that the microphone has a mute button. I got that one. But any other criticisms or recommendations or what you'd like to hear us talk about in the future, please send those in. We take those to heart. Appreciate that. Wade, what do we have in the way of questions?
Yeah, so first one is a question that tags on to the types of buyers. What type of buyer are fundless sponsors? I'll also add on to that, since they usually tie hand in hand. What would be a search fund as well?
What's a fundless sponsor? What's a search fund? What buyer type are they? So fundless sponsors never call themselves fundless sponsors. They call themselves independent sponsors or search funds. And so these aren't legally defined terms. They're not, you don't go register with the SEC or something with the IRS as one of these categories. But what they are is they're a range of things. On the kind of skeptical end, there are people who are trying to pose as private equity funds that are not private equity funds. And so they're kind of a poor cousin of a financial buyer. I don't have the money, but I can go get the money type of thing, right? So that's the skeptical view. Other end of the spectrum, it's a new model that the financial buyer world is moving to, where unlike the traditional model I laid out, where they have commitments from insurance companies and private and pension funds, for example, they don't have the commitments, but they have the relationships. And rather than having people invest in a fund and then that management company or general partner decides what to buy, they have to sell the deals individually to their limited partners, their silent investors. And it may very well be the exact same group of people that a traditional private equity fund has. They're just not committed ahead of time to allow that professional money manager, that professional finance person, to make decisions about what to buy and not buy. So they have at least one extra step in the process to get the deal done. They have to go get the money that's been kind of soft circled, is a common term that's used. And so the certainty of close, so talking about our 3 priorities, what's the value? They do often, because they know they're viewed a little bit more skeptically than a traditional financial buyer, they will often offer to overpay to compensate for the lower certainty of close that they have. And they definitely have a lower certainty of close because they have at least one extra step in the process. And they will all say that they have the people lined up, and there's really no way to determine that for sure. A good broker can help kind of categorize that risk, but it's just always a little bit of a gray area. So they are a type of financial buyer, will offer higher value. They may be a better fit, or they may be a worse fit. So that depends on the individual seller and the individual search fund or independent sponsor. But the trade-off is a higher risk of a blown deal. It's lower certainty of close. But yeah, definitely a type of financial buyer. And the difference between a search fund and an independent sponsor or a fundless sponsor, they're kind of all used interchangeably.
So I had another one here. It's actually a question that I'm going to add on to, but how do I know what type of buyer is best for my business? And I think I also want to add on to that, because I think it ties into what should a business owner do to make a company more attractive to a certain type of buyer? Yeah,
okay. So, well, hopefully what we talked about today was helping you figure out the type of buyer you're attractive to, but this is really just kind of skimming across the surface. You get in with someone that has some experience and dive in there and kind of, you can talk for days about answering that question, but you really, unless you have someone who's seen a lot of buyers and taken a lot of companies to market, they're not going to know what type. They can't give you the definitive answer. We covered, 5 to 10 kind of high level things that should kind of point people in the right direction. So I'd say review the PowerPoint that will, the PDF that we'll send out afterwards for a starter. But to get deeper than that, you really need to have somebody who knows buyers come in, look at your business, figure out your business, and figure that. That was the first part of the question, was what.
How do I know what buyer is best for my business?
Start with this presentation, get some help from someone with experience with lots of buyers. And second question, or second half?
Yeah, what should a business owner do to make a company more attractive to a type of buyer?
Oh yeah, so first of all, you got to stay true to those 3 objectives. So the first thing is sit down with that piece of paper that has the 3 objectives with nothing written underneath, and write your thoughts out on all 3 of those, right? Because if you have a high priority for certainty of close, right, then maybe you don't want to be you don't want to prepare your business to sell to a fundless sponsor. Or if you want to retire right away, as soon as possible and get out, you probably don't want to aim towards private equity fund. So that will help you decide, because you can't make every improvement for every type of buyer. Everything costs money, and money is limited. So kind of first get your best take on what type of buyer you're planning to go for. And then you go back and look at this and think about, what's a person who looks at spreadsheets going to be most worried about? Let me fix that. Or if you think you're going to go to a strategic buyer, what are things that operationally someone's going to come in, somebody who knows the industry is going to look at and be worried about, and try to address the major concerns first. So we're big believers here that it's better to go to market with your defects, get out, particularly when the market's hot as it is now, get out to market, and buyers will pay you for that opportunity, right? So if you go out and spend $100 fixing a problem, it's like redoing the bathroom or a kitchen in a house. You may not get the $100 back in the sale price, because if it costs you $100 to fix that, a big buyer comes in, they might be able to fix it for $80. So, another example is, suppose that you decide your accounting system isn't good enough. So you go from kind of a level 2 accounting system and you go out and spend more money on a level 4 accounting system. Publicly traded buyer comes in, has a level 50 accounting system, and all that money you spent going from 2 to 4, they're not going to pay you a penny for that. So it is so hard to guess what, you can make a few assumptions about buyer types based on what we went through today and kind of try to knock off a few of the big things. But, we've seen clients who have gone out and done a lot of things before they came to us that they don't get the money back on them, just like real estate brokers see with houses. So I wouldn't put too much effort into trying to do that. It's more about how you present the information as opposed to what you actually do with the business. As I said, everybody wants to buy a business with defects. If you eliminate all the defects, the business is now worth as much to you as it is to the buyer. So I wouldn't worry about that too much. That's the short answer.
Good. I did have one more here, which is very broad, but how much usually is paid in cash? And I assume that is at the closing table.
Yeah. So again, it's going to depend on the different buyer type. But to speak in broad generalities, we're seeing now 60-70% cash at close, consideration at close. Sometimes it's in the form of a publicly traded company stock. So 60-70% at closing, and then the other 2 buckets are kind of the deferred, which would be like seller notes and salaries and things that are are not contingent on something happening. They're going to get paid down the road. That's about 10 to 15% of 15 to 20% of the remaining piece. This is the second biggest slab. And then we're seeing kind of 10 to 15% in the contingent things like earnouts or bonuses or revenue shares. So kind of about a 60 to 70, a 15 to 20, and a 10 to 15. Those are the way the 3 buckets are divided up. And the key, again, because that fit can be a win-win solution, the key is making sure that that deferred piece and that contingent piece are the lawyer knows what they're doing. So 10 years ago, when lower middle market M&A was all about cash at close, pretty much any lawyer could do an M&A deal. But now, because you're going to have kind of 20, 30, 40% of your consideration is going to be deferred or contingent, you really need a specialist lawyer in there to help protect you on that part of the deal. And so now, much more so than 10 years ago, like 100 years ago, if you had a heart problem, you went to the doctor. If your foot hurt, you went to the same doctor, right? Nowadays, if you go to have a heart problem, you go to the doctor and say, is it the left ventricle or the right aorta? Because that's two different doctors, or is it the right foot or the left foot? Because there's two different doctors for right foot and left foot. And that's kind of what's happened with M&A and lawyering in the lower middle markets. It's gotten very specialized because that is a significant portion. Now, again, when the market goes back to normal and everybody's getting 3 and 4 time multiples, and everything's cash at close, then you can go hire any lawyer off the street and it doesn't matter. But you want someone who knows those norms and knows how to get the protections in place, because that makes those so much more valuable. All right, that's it. Again, please send us your comments. Sorry about the issue with the microphone at the beginning, growing pains, I guess. And don't forget, you can still download all the PDFs. Thank you very much.